Commodity overview and catalyst breakdown. Copper futures are maintaining strong momentum near historic territory, with COMEX spot copper trading at $6.36 per pound, equivalent to approximately $13,500 per metric ton on the London Metal Exchange. While broader equity markets react to quarterly corporate earnings, physical commodity channels are experiencing an acute supply bottleneck. The latest warehouse data from the London Metal Exchange confirms a 4.69% week-over-week draw in global stocks down to 281,425 tons. The primary catalyst driving this squeeze is unprecedented contraction in refined concentrate. Smelter treatment charges, or TCs, have plunged to historic lows, forcing global smelters to curtail production due to severe winter weather disruptions across major Chilean mining hubs. Macro drivers and central bank forces. To evaluate institutional capital flows into industrial metals, we must look at foreign exchange momentum and central bank policy expectations. The US dollar index, DXY, has been trading in a consolidation band near 101.5, while the 10-year US Treasury yield holds near 4.70%. When dollar momentum settles alongside sticky real yields, institutional asset managers seek exposure to hard physical assets that capture non-discretionary economic expansion. Unlike monetary assets that react strictly to central bank interest rate decisions, copper sits directly at the intersection of macroeconomic liquidity and sovereign infrastructure spending, giving it a dual growth driver. Physical inventories and supply-demand dynamics. Turning to physical supply and demand, the copper market is facing a structural deficit that mine output cannot easily resolve. Bringing a new primary copper mine from discovery to commercial extraction takes 12 to 15 years due to permitting regulations, lower ore grades, and water constraints in South America. On the demand side, physical consumption is being permanently reshaped by the rapid expansion of artificial intelligence infrastructure. A single gigawatt-scale AI data center requires approximately 50,000 metric tons of refined copper for heavy-duty transformers, high-voltage busbars, and specialized liquid cooling systems. Combined with massive power grid modernizations globally, this inelastic demand driver is creating a persistent structural deficit that continues to deplete global warehouse stocks. High-impact USA stock winners. For U.S. equity investors, elevated spot copper prices translate directly into expanding free cash flow for premier domestic miners. The leading beneficiary in the U.S. market is Freeport-McMoRan, NYSE, FCX, the world's premier publicly traded copper pure play. Because FCX maintains a largely fixed cost structure across its mining operations, every 10-cent increase in realized copper prices adds approximately $350 million to $400 million directly to its annual EBITDA. Our second key winner is Southern Copper Corporation, NYSE, SCCO, which holds industry-leading copper reserves and some of the lowest cash extraction costs globally. SCO's high operating margins provide exceptional balance sheet stability while supporting robust dividend payouts to shareholders. For investors seeking broad industry exposure without single stock execution risks, the Global X Copper Miners ETF, NYSE, COPX, provides a liquid, diversified vehicle tracking Tier 1 global extractors. Squeezed USA stock losers. While upstream miners benefit from expanding margins, sustained high copper pricing acts as an input tax on downstream U.S. manufacturing sectors. Unhedged electrical equipment manufacturers and power hardware integrators represent the first wave of margin risk, as rising raw copper input costs compress gross margins when price increases cannot be immediately passed on to buyers. The second major sector facing margin pressure includes high-volume consumer durables, appliance makers, and heavy industrial machinery producers. In these manufacturing businesses, raw copper represents a significant percentage of total bill of materials costs. When spot copper stays elevated above historic baselines, these downstream manufacturers typically experience a 150 to 250 basis point reduction in operating margins, making selective stock picking essential. Forward look and technical roadmap. Looking at the technical chart roadmap for COMEX copper futures, $5.80 per pound serves as primary institutional support, with $6 acting as a key floor. To the upside, a confirmed breakout above $6.40 opens the technical pathway toward the record high resistance zone between $6.65 and $6.72 per pound. Over the coming week, institutional traders will monitor upcoming S&P Global PMI reports, US dollar index volatility, and weekly inventory changes across LME and COMEX warehouses for further confirmation of physical market tightness. Maintain a disciplined allocation strategy by utilizing technical pullbacks towards support as potential accumulation zones for Tier 1 US producers like Freeport-McMoRan, FCX. To see how copper's macro signals link directly to our daily US stock market coverage, click the video on screen right now to access our full US market playlist. Make sure to subscribe to Global Macro Pulse, and we will see you in the next update.